In most discussions about reserve funding plans, there's talk about the two different ways to calculate reserve contributions. One is the component method, which some also describe as straight line. The other is the cash flow method, sometimes called the pooled method. Let's look at how both these methods work.
Well, Ian, it was good to learn that there's actually a pretty narrow range of reserve contributions that are best for every particular association. Now, but because those contributions are driven by the needs and the ongoing deterioration of those components, I guess, that's not too surprising that there's one kind of narrow solution. With a set of expenses, you need a set of income to offset those expenses. So it's really not too surprising. But now, tell us about how an association gets there, how the reserve contributions are actually calculated.
Yeah, absolutely, Robert. Thanks. The goal is to set aside enough funds, like we said, to offset deterioration and to prepare the association for these inevitable upcoming expenses. Sometimes it seems like a wheelbarrow of money.
Or a bulldozer full of money.
Exactly. We're guided in this by National Reserve Study standards that tell us that any funding plan should provide sufficient cash, be stable from year to year, be evenly distributed over the ownership over the years, and be fiscally responsible. So those are kind of what we would say the rules of the game. There are two ways to compute the contributions. You can think of them as two different tools. Usually, this is a choice made by, in the background, by your reserve study professional. But in some areas of the country, state law gets involved. This choice of computational tool is significant because even with the same component list, starting balance, and same interest and inflation assumptions, contribution sizes can differ 50%, and that's pretty common. Follow along and I'll explain. So the component method looks at each component individually and calculates a reserve contribution for each one. So think of it as an up and down method. And calculating all the individual pieces and summing them up at the bottom.
Line by line by line by line by line, just all the components individually.
Exactly.
Okay.
And then the cash flow method doesn't look at individual components. All it looks at is the reserve expenses over the years. These expenses are the reason that the reserve contributions are being collected. As you can see, you don't know what makes up for all of these expenses from year to year. Painting, roofing, asphalt, pool resurfacing, whatever it is. It's just a reserve expense. So you can think of this as a left to right method.
So it's the same components, just kind of two ways of looking at it.
Yep, they're all grouped together in this case. Let me show you a little more detail about the component method and its nuances. By nature of its name, the method is based on the computations done on each individual component. Because each component stands on its own merit, each component needs to get funded quickly enough to be prepared for its next occurrence. Let me show you what I mean by that. This is the component list we've been working off for this webinar. By focusing on the individual line items, looking at the highlighted cells, you'll see that the component method will require the pool furniture to have $4,600 in the initial year to pay for the bill for the pool furniture. The asphalt seal and the asphalt resurface funds need to each have $5,000 and $25,000 respectively within 2 years. And the building repaint fund will need to have $50,000 by next year. Getting enough cash into the reserves for these 4 individual funds while still funding for all the others will require some high reserve contributions in the short term. If you actually do the calculations year after year, presuming the association follows the plan, this is what a multi-year funding plan will look like. High in the first few years while the association is in a steep catch-up mode, rapidly strengthening its reserve fund as it prepares for those near-term components while funding all the other components. After those initial expenses, contributions drop down to a stable rate of deterioration level. because after the expenditure, those funds have the entire useful life of that component to collect enough for the next replacement. So with the component method calculations, the normal profile is to have high contributions for a while in the first few years and then dropping down to lower contributions later. But unfortunately, those initial recommended contributions are high enough that the association never quite gets caught up. So again, I want to make this clear for you all, and it's an important concept to understand. This association's catch-up mode. Contributions calculated with the component method will be high for a few years. So again, throughout this whole webinar, if there are any questions or any further clarification, please type it into the text box and we'll be happy to go over that at the end. Because every component stands on its own and each has to get ready for its own upcoming expense, the component method only pursues the conservative full funding goal. So while it's not very flexible, only directing the association towards a conservative full funding goal, the advantage of the component method is that the calculations are very simple. It's just a matter of line by line, simple calculations that could easily be done with a calculator. But because the average association is underfunded, component method calculations for underfunded associations yield high contributions in the first few years. And that makes the component method funding plans a tough pill to swallow for most associations. Okay, so let's shift gears for a second to the cash flow method. Remember, nothing has changed with respect to the components. We're funding the exact same expenses. This way of calculating reserve contributions focuses on the annual expense totals, not individual components. So for a 30-year plan, there are 30 expenses to deal with, no matter if you have 5 or 55 components. So in looking at the expenses over the years, the cash flow method doesn't care if it's a year expenditure is for one project or a combination of projects. It's just how much reserves are necessary to pay the expense in a given year. It's kind of like planning for a flight plan for an airplane over a mountain range, preparing to fly over the peaks along the way. And analysts have the flexibility to create a funding plan that barely crosses the mountains, with more of a conservative plan that crosses some additional margin. So again, just creating this funding plan. And because of its flexibility, you can design a nice, smooth funding plan that floats upwards with inflation, so current and future owners effectively play the same inflation index contributions, all while providing sufficient funds. Now again, let's contrast that with the component method profile I showed you from a moment ago, where contributions start high and then drop later. Here's the cash flow chart again, now showing the average of contributions over the years in yellow, again with that steady climb. Here's the component method chart showing the average contributions over the years in yellow. Due to the funding being the exact same components, the amount of cash going into reserves over the years is very similar. Other things being equal, only the profile is different. Again, we haven't changed any expenses. This is why there can be such a difference between cash flow and component method reserve contributions. It's not the amount of cash going into the reserves over the years. It only looks like a big difference when you only look at the first year.
Yeah, Ian, can I break in here? Let's look at the component method. It's what, $5,000 per year, or excuse me, $5,000 per month. And I'm going to go back a slide down to $2,000 some dollars a month. That's a big difference. In this case, it looks like a doubling, and that's all just the first year difference, because that average is what, $3,600, $3,700 if you average it out through the years?
Exactly. They come out to about the exact same average. It's just how you get to the end goal.
Right, because it's exactly the same expenses over a 30-year period.
Exactly.
Cool.
So here's another way to look at the difference between the two, an accounting issue. Remember, in the component method, the reserve fund is divided into separate accounts for each component and may look something like this. Unfortunately, the case too often happens that the association's needs, for argument's sake, funds for the asphalt and fencing, and some reason the funds allocated to those components are now underfunded. So the association is forced into reassigning cash from one account to another. It's a lot simpler if you break it down, break down the barriers, making sure the same cash is available for all scheduled reserve projects. The cash flow method also totally eliminates the accounting task of tracking funds in each separate account and inevitably reassigning those funds from one of the components to another when and if it's necessary. It's kind of like having one reservoir or pool of money. And this is why the cash flow method is sometimes referred to as the pooling method. Remember, both methods fund exactly the same expenditures. This flexibility in the cash flow method allows the user to create more or less margin, meaning it can be used to achieve any of the 3 National Reserve Study Standard funding goals: full funding, threshold funding, or the barely cash positive baseline funding goal, just by adjusting more or less the funding going into reserves. So the cash flow method is nice and flexible, but it's too often it has been used to design contributions pursuing a risky baseline goal that runs the reservoir dry, as we were talking about earlier.
I'm sorry, I'm following along with you, and I'm loving what you're saying.
Absolutely.
You're making it real clear.
With the first year of contributions, they kind of look ridiculously small compared to the component method calculations. Looking at just the first year, it's an unfair comparison. Over the years, the net contributions between the two are the same because they're funding the exact same expenses. But when comparing only the first year, the cash flow contributions are regularly much lower.
Ian, I think that's the key. And you've made it very clear that they might be funding or looking at it 2 different ways, up and down versus left and right, but it's exactly the same expenses. Over the years, it's going to be exactly the same contributions, but it's kind of that unfair first year only comparison that gets people all pushed sideways. Is that kind of how you see it?
Yeah, that's absolutely right. It's how we're going to get to the end goal and trying to do the best we can to spread those costs out, over many years.
Right. And that's bringing back the National Reserve Study Standard funding principles that you want sufficient funds, budget stability, equitable distribution, smooth distribution over the years, and then something fiscally responsible. So it's guided by national standards, and you can get something that looks a little bit smoother with that cash flow method.
Yep.
It all makes sense.
If you have any follow-up questions on this material, please ask them in the comments below or contact us directly through our website. There you can get a proposal for your association or find other helpful resources in our articles or other recorded material. Make sure you also subscribe to our channel for more content like this. Let's plan for your best future.